Today, we will find out if Shopify is still all that or a washed-up growth titan, and we will begin right now. When it comes to Canada's tech sector, we do not really have very many massive companies like they do south of the border. However, one of the larger technology companies that we do have is Shopify. They absolutely exploded in value between 2018 and 2021 and look to be unstoppable. However, things were about to change with the bear market and an 82% drop, turning our unstoppable technological pride into a wee shade of its former glory. Shopify fell hard, and many expect that they will never truly soar again. Of course, there is also the camp of investors that are betting with their dollars that Shopify will shrug off the bear market and rebound back into the skies on a trip towards that mythical moon. As for me, I am in whatever camp the fundamentals make the most sense for. Before we head to our online shopping cart, let me know in the comments if you have ever held any Shopify. I currently do have a few shares in my TFSA. As always, I am very grateful to see you all here in the home of free financial content on YouTube. If you are new, please subscribe right now so you won't miss a single moment, and a huge thank you for that click. Shopify was founded back in 2006 by a pair of snowboarders who were dissatisfied with the state of current e-commerce platforms they encountered while trying to buy, yes, you guessed it, snowboards. Holy banana bread. Innovation can have some pretty cool beginnings. By 2010, they had a free mobile app, and they were named Ottawa's fastest growing company by the Ottawa Business Journal. Their story was growth, and boy did they grow into a multinational e-commerce platform. Shopify is worldwide, and their growth propelled them into the top 20 publicly traded companies in Canada by, of course, market capitalization. In 2021, before the bear market, Shopify's platform was used by 1.58 million websites, which is a massive stake in the e-commerce market. Why did Shopify stock drop so much? Obviously, there was the bear market, and that alone contributed to a good portion of Shopify's woes. In addition to the bear market punishing them, they also had a pullback in consumer spending due to recession fears and increased competition. Part of consumer pullback was people returning to physical stores and taking their dollars with them. One of the big competitors that is set to carve away some of their business is Amazon and their Buy with Prime service that will allow third-party sellers to take advantage of the capabilities Prime has to offer. Shopify has also had to lay off some of its workforce as they found themselves in an overstaffed position once the good times began to peter out. Looking at all of this, it still really doesn't give us as investors the real skinny on Shopify. We need to look at the numbers. We will begin as usual with some surface data. Their market cap is $40.7 billion, making them a large cap company. With their explosive growth in the past, that is not too surprising. Their beta comes in at 1.82, which means they are very much more volatile than the market average. Their earnings per share comes in at 0.19, and they really do not have any concerns with dilution. Shopify's current earnings, though, are not great at all, and they currently are not, well, they're not in a profitable position. Their price to earnings ratio comes in at negative 21.80, which is very reflective of their current issues. We all know a negative PE ratio means that they are losing money. In fact, in the last year, their earnings growth came in at negative 177.5% compared to the industry average of 19.8%. Holy banana bread, that's not really good at all. They have been working on reducing their losses, but that is definitely a work in progress. When a company is unprofitable, it is often more useful to look at their price to sales ratio, which in Shopify's case is 7.90. A smaller price to sales ratio is considered good. The industry average is 1.4. So Shopify is, well, they're a little high there too, which can mean that, well, they may be overpriced. Does that indicate they still have more room to fall? Well, maybe or maybe not. If you calculate Shopify's fair price to sales ratio, which is the expected price to sales ratio based on their other fundamentals, it comes in at 9.40. So Shopify is below that, which may be reassuring a wee bit in regard to their bottom. However, if you calculate their fair value based on calculated future cash flows, we get another story. My friends over at simplywall.st and their discounted cash flow model are predicting a fair value of $17 $1,086.36. That could be rather concerning, and we will certainly look at that when we get to the final verdict. If we shift to returns, Shopify is a growth stock without any dividends at all. They entered 2021 with a share price of $136.86, adjusted, of course, for their stock split, and then they grew to $183.34 by year's end. This results in a return of investment of 34.0%. Okay, that's not too bad. Oh, but now we've got this year. So far this year, they have fallen to $41.35, and that is a return of investment of negative 77.4%. This alone has many investors a wee bit on the fearful side. There really is nothing here to be happy about. Nothing. It is time to look at their debt. Usually I do not look at debt to look for the silver lining, but in this case, their total debt, it's only $912.1 million, and that may very well be the shining part of their fundamentals. When we look beyond debt and take in all liabilities, they come out ahead in both the short and long term. Short term, they have $7.9 billion in assets compared to $703.2 million in liabilities. If we look long term, they have the same $7.9 billion in assets compared to $1.3 billion in debt. This really is not too bad. But is it enough compared to all of the other fundamentals that were in the pooper? So, what is the final verdict? These fundamentals will make many of you run for the hills with this one. I do not blame you, as I think Shopify has a lot of pain still in the short term. They have a lot of potential to become profitable again, but it will not be a short fix. It will not be an easy fix. Short term, this is 100% not a company you want to look at, as it will take time to make your profits on that investment. Long term is a different story, as this company will eventually get their business model sorted out, and good times will more than likely return. They could be a very good investment if you are looking for more than 3 years out. If that is what you want to do, and you have put in your due diligence, this is one to approach with a dollar cost average strategy, as there still is a chance of it dropping even further, as I mentioned before. However, long term, these will be prices you may be very happy about dipping into Shopify with. The fun does not have to end here, because you can always watch my video on CP Rail that I have linked on the left, or you can check out that video on the right that YouTube thinks you may like a little bit more. Your click will decide who is right, and I will see you in the next video.